And in this segment, what we're going to be talking about is short-term rentals and how all that plays out. Okay, so if you're not into the short-term rental game, you're really missing out on some huge tax savings. Now, I know there's income that can be made from doing short-term rentals, and if you've seen my channel, I've talked to several people about the money that can be made in short-term rentals and how to set that up. But it's the tax side that really gets people excited when it comes to using short-term rentals. And I'm not saying that you have to use short-term rentals full time, but the thing is that with short-term rentals, you can actually use them or use that property as a short-term rental for a bit. And then if you want to later on, you can turn that into a long-term rental after you've harvested the tax losses. So what I'm going to be sharing with you this afternoon is how to set up that structure for the short-term rentals and looking at it from the tax benefit side that comes from using it. All right, so with that being said, let me get everything hooked up here the right way, jump over to the iPad, throw up the picture. All right, so when it comes to taxation in short-term rentals, the reason why people tend to gravitate towards this from a tax perspective is that you've probably heard of REPS before, right? That's real estate professional status. And there's a lot of benefits that come from being a real estate professional, but the problem with being a real estate professional or just qualifying for it is you have to spend 50% of your time and 750 hours in a real estate related activity. And so once you've satisfied that, okay, which is a hurdle in and of itself. So if you work for someone else, you're not going to qualify, or in a non-real estate related field, you're not meeting this test. So you have to actually go out there and work in a real estate related field 50% of your time and spend 750 hours to qualify for reps. And then once you get that done, then you need to what we call materially participate in your rental properties. And there's 7 different tests that you apply here. And of course, the 2 tests that most people use are 100 hours or 500 hours. 100 hours being that you spend 100 hours on your rentals, it's more than anyone else, or you spend 500 hours on your rental property, and it doesn't matter who spends what amount of time on there. So generally speaking, this is where a lot of people used to gravitate towards. And the reason they would do that is because if you qualify as a real estate professional, what you're doing is you're able to then take your losses that are considered passive from real estate. So for example, here, if I have all these properties that I own and they throw off with depreciation $30,000 in losses, if I qualified as a real estate professional with the material participation component, then those losses are no longer passive. They become just non-passive losses, which means I can then use them to offset my ordinary income. So if my spouse was generating $75,000 a year in her job, I could take the losses from my real estate, offset that, and just pay taxes on $45,000 in income. But the problem is that this is an onerous test for a lot of individuals. I work with a lot of physician clients who struggle with this because, as you can see, I mean, 750 hours and 50% of your time, if you don't work in that real estate related field, you're never gonna make it. So one of the benefits we have with short-term rentals is it allow us to apply a different test so that we can still get those losses, but we're not subject to this onerous 50% 750 hours. And this is what we tend to do or recommend to individuals who can't qualify for reps, but they have properties that they can harvest losses out of. I'm going to make a recommendation that you turn it into a short-term rental. At least initially you turn it into a short-term rental, and then you can change it to a long-term rental at a later date, and the purpose being to harvest the losses that come from the property. Okay, so what are we looking at here? So if you have a piece of property and you want to make this property a short-term rental, so there's basically 2 tests that we have to pass to turn this property into a short-term rental. The first test you can qualify under is that the average rental period is 7 days or less. So your average rental period is 7 days or less during the entire year. So you can have some rental periods of 12 days, some of 2, some of 21, some of 4, not too many of 21 hopefully. And then when you add them all up and you take the average of your rental periods, if the average rental period works out to be 7 days or less, you're on your way there. So you let the rental do the work for you just by keeping it under 7 days or less. Then, once you've met that prong, the second prong of this requires, and the easiest one I think, is the 100 hours requirement. So if you spend 100 hours on your short-term rentals, and that 100 hours is more than anyone else. So this is where you can get tripped up. If you have house cleaners come in and maintain your property, have them provide a time log. So if you're ever audited, you can say, well, when I had someone come in and do a turn, they would spend on average an hour, and I only did 50 turns this year, so we had 50 hours of time spent on this one property. Now, if you have 10 properties, you can see that that time's going to go up, and you're going to have 500 hours, you're going to have a problem there. But if you have one property and they spend 1 hour to do the turn, well, then you may make it. Or if they spend 2 hours, tell them on one of those 50 turns, they only spend an hour and they'll come in at 99 and you'll still beat them. So you have to keep track of your time and the time of other people who are coming in and working on your property. So that's the easiest one. If you can't satisfy the 100 hours, then you can always fall back on the safe default, which is 500 hours. But I find that most of the clients I work with, if they're investing in short-term rentals and they're looking to take advantage of this, they're really going to shoot for that 100-hour requirement. Now remember, when I say it's 7 days or less for the year, well, 7 days or less for the year means this taxable year. And here we are now in September. So you have October, November, December. You got 3.5 months left. I think you could probably do it. In fact, I helped a client last year do something similar. A physician that exited out of a clinic that he sold, had a big windfall, rolled it into a property, and we got some huge tax deductions, as I'll show you. So for short-term rentals, if you want to get your tax deductions, then what you want to do is first keep track of your average rental period and how much time you spend on your properties. Now, after that, if you can't satisfy the 7-day test, then there's a secondary test you can look at. It's called 30 days or less, all right? And you provide substantial services. So what do we mean by that? Well, if your average rental period is 30 days or less, and you provide substantial services, then you're going to be able to take that income and you're going to be able to make it non-passive. Again, assuming you also meet the material participation hours, 100 or 500. But the thing is, what they're looking for there is if it's not 7 days or less, but it's between 7 and 30 is your average rental period, then you're going to have to do a little bit more on your end to turn this property into something which the losses that flow from it can be used to offset your other income. So the question often comes up, what is considered to be substantial services? Well, I tell people, think of it as follows. If you were to go into a high-end rental, what types of things would you like maybe the owner to be able to provide to you? Daily maid service would be one thing. Maybe they can set you up with excursions. They can arrange for cooks that can come in or chefs and prepare a meal for you. Things like that, tickets to events. So you're doing more than just, here's the keys, enjoy your time at my property. There was I forget what's the ski resort, the name of it, that we were going to go up to, but somebody got sick with COVID and we couldn't make it. But the property itself, the proprietors of that property, they had a number of different things or options for us where they arranged to have skis brought in if we needed snowsuits or things like that. They provide for it, recommendations and car service to go out to dinner. So they were working extra hard to make sure we had a great time at this chalet. But also, because it's a short-term rental and the way they're renting it out, they're definitely providing what we call substantial services. So if you're doing this test down here, the 30 days, because your average rental period is more than 7, then again, you also have to either spend 100 hours or 500 hours. So that's that material participation element of the property. So why do you want to look at this, and why is this important to you, or should you consider turning one of your properties into a short-term rental? Well, it's as I stated earlier, it's the tax benefits that come from it. So I have a client right now that is closing on a fourplex. All right, there's this fourplex that this client's closing on in Dallas. Now, this property here that they're closing on is $1.4 million. And during our discussion, what I said to her is that she should take this property, because initially what she wanted to do was close on it and turn it into a long-term rental, get into one-year lease agreements with tenants. I said, hold off on that for a moment. Okay, your husband is a physician, all right? You're a physician, so you make good money and you have relatively no tax deductions. So you can't qualify as a real estate professional. So the strategy that I'm going to tell you from a tax side won't benefit you all that much. How would you like it if we could find a way to generate for you, I don't know, $400,000, maybe even $500,000 in tax deductions, be able to harvest those for you? Now, of course, when you start talking about numbers like that, that gets everyone really interested, and they're thinking, man, that's something I would like to have, because if you're in a, say your effective rate, these people are in California, 45% tax rate, $500,000, that's basically putting $215,000, $20,000 back into their pocket by doing this one strategy. So as I explained, I said, let's take this property initially and turn it into a short-term rental. So you're going to turn that property into a short-term rental, but the key is you're going to have to manage it. You're going to have to do all the work, and you're going to have to log at least 100 hours before the end of the year and make sure no one else logs more time overall on this property, or you got to hit the 500 hours for it. So if you can do that for this year, then this property will qualify, provided the average rental period is 7 days or less, as a short-term rental. And if it qualifies as a short-term rental, then what we can do to harvest these tax deductions is come in and perform a cost segregation study on the property. Now, if you're not familiar with cost segregation, I have some videos on this. And it's what we call accelerated depreciation. You're going to break the property's components up into 5, 7, and 15-year and 27.5-year elements, and then take the 5, 7, and 15-year elements. What are those? Sinks, electrical wiring, HVAC, countertops, floorings, landscaping. Every component that really isn't that structural, we're going to depreciate it on a much shorter time period than the average 27.5 years for residential real estate. And right now, with bonus depreciation, we're able to go in then and take all of those properties, 5, 7, and 15-year property held that comprise this one fourplex, and we can deduct it all in year one. And so the strategy then is to perform the cost seg on the property, hopefully pick up between $400,000 to $500,000 in accelerated depreciation, bonus that out, and if you meet the test, then that becomes immediately deductible to you. So if she and her spouse bring in $1 million in income, they'll be able to take, if it was $500,000, $500,000 tax deduction, and now they're only paying tax on $500,000. Now, she is willing to commit to the efforts to do this, but one of the things she said is, hey, my only concern is I can't see myself doing this long term. I said, I get it. You can't see yourself doing it long term. Don't worry. You just have to do it for this tax year. Next tax year, turn it into a longer term rental. Now, what do I mean by a longer term rental? Well, anything over 30 days, right? To get it out of the short term rental area of the code. So it's got to be more than 31 days or more, and we're going to make it a long-term rental, and it'll fall back under that. So this is the plan. So if you own residential real estate, And it could be existing property that you own. If you want to use this strategy, if you own existing property, this would qualify. You can convert it from long-term into short-term, and then go in and look at providing a cost seg study, have that done on the property, and pick up some of those losses. But here's the key: if you have existing property, let's say I bought this property here, you have to make sure that this property that you own, that you want to perform this study on, was acquired after October 1 of 2017. It has to be acquired after October 1st of 2017. Actually, it could go back to September, but I forget the date, in order for it to qualify for that bonus depreciation. So if it's older than that, you're not going to get the bonus. You can still do a cost seg, but it may not be as beneficial as what I'm just sharing with you. Now, as far as structuring, how are we structuring this deal? With entities, I'm not doing anything different than I normally would. I'm just going to create a limited liability company here, and I'm going to roll that down into a Wyoming holding company down here for her. And so she has the anonymity, and then the LLC itself will own the actual property. She will still be able to qualify under the short-term rentals because she is the member, she's the manager of the structure, she's the one participating in the underlying activity. So that will free up the tax angle there for her. So with short-term rentals, the structuring remains the same as if they're long-term rentals, but the key is in the tax play. Now, I see there's a bunch of questions coming in. I'll get to your questions, guys. I want to go into this as well. There are some people, though, that have already met real estate professional status. Now, if you're one of those, you've got problems, okay? And what I mean by that is that if you're already a real estate professional, okay, so let's say you have rep status and you have 10 long-term rentals here, and you pick up your first short-term rental because it's something that you want to get started in. You pick it up in a desirable location, and let's say this property ran you $750,000, and you're thinking about doing a cost seg study on this, and you've been told, hey, if you did a cost seg, you could probably get $200,000 in tax deductions. So you're looking at that and you're thinking, well, I'm a real estate professional, so heck, let's just do it. I'll pick up those tax breaks. Well, here's the problem. As a real estate professional, okay, as I talked about, 50% of your time, 750 hours, and then either 100 or 500 hours of material participation on your properties. That time right there only counts for these properties here. You can't use this time down here. With short-term rentals, the material participation time can only be used towards the short-term rentals, so you can't group them. And herein lies the problem when it comes to real estate professional status and using short-term rentals. So what you want to do is take this short-term rental and turn it into a long-term rental. So LTR, not TTR. So how do you do that? Well, what you want to do in that scenario, if you're already a real estate professional, is you put your short-term rental then into a limited liability company as follows, and then you have your holding company down here, as we've talked about. And so in this structure here for this client, I would have it just structured like this. I would have 10 LLCs set up. Okay, these are the existing properties. Here's the new short-term rental property. Stick it in that LLC. And then I'm not going to run the business out of the limited liability company itself. Instead, what I'm going to do is I'm going to create a corporation up here. So I'm going to create a C Corp. Now, this could be a limited liability company, or it can be an Inc. It can even be an S Corp. I'd prefer to do C Corp, but you can make your own choice there. Now I'm going to enter into a 1-year lease with my corporation. So my corporation is going to lease the property from me on a 1-year lease. You see what I just did? I took this property, by leasing it to my corporation on a 1-year lease, I turned it into what? Short-term rental or long-term rental. It's now a long-term rental, so it qualifies under my current properties for rep status. So it's part of my aggregation election that I've made. I can group all my properties together there, and I'm good to go. Then I'm going to take my C Corp up here, and this is going to engage in the short-term rental business. So up here, I don't even care, 7 days or less or 30 days. None of that's even relevant to me anymore because I'm not trying to qualify under what people call the short-term rental loophole to pick up the deductions, because what I did is I turned this into a long-term rental. So now it qualifies under reps that I have, and since I'm a real estate professional and this is a long-term rental property, I can use the cost seg study now, pick that $200,000 up and use it on my tax return. So when you're looking at these deals, you just have to think about it and be creative and find a solution to what works best for you in your given situation. You know, if you didn't, say you're looking at this, you have property that you acquired before 2017, you're thinking, hey, I'd really like to pick up some tax deductions before to the end of the year. Well, there's one way you could do that. If you wanted to do this, I've cut a video on it. I recently, I think it's hit already. What you could do with an existing property, let's say I bought this property in 2012 and I want to perform a cost seg on it and pick up the bonus depreciation to reduce my taxes. Well, the problem is it doesn't qualify for bonus depreciation, so it's of marginal value to me to use that study. So instead, what you might consider is selling the property. So do a 1031 exchange on this property and buy a new property. Buy up. So let's say this property you bought for $200,000. It's now worth $500,000. Do a 1031 exchange into say a $1 million property, right? Roll into that. Since you acquired this property in 2022, it's now eligible for the bonus depreciation that comes with a cost seg study. So now you've got this property here that's acquired this year. Take this property, again, put it into a limited liability company, turn it into a short-term rental for the remainder of the year if you can't meet rep status. And now we're just back to what we're talking about before, 7 days or less. Keep your rental periods of 7 days or less through the end of the year. Then you're going to qualify for that cost segregation with the bonus depreciation. And so this is an example of someone that I was talking to a couple weeks back who posed this dilemma. They said, Clint, I got this property, but it doesn't qualify for what you're talking about. I said, well, sell it. Well, I don't want to pay gain on it. Do a 1031. Then you qualify yourself to engage in a cost segregation study with the bonus depreciation. So you can get there. It just maybe you have to take a few extra steps. And so what is key here? The key to doing all this is that your property has to go into service. And so that means you actually have to start renting it out in 2022 in order to qualify. We've had some clients that have bought the property and put it in service in December, rented it out for four different rental periods in December, average period of 7 days or less. It qualifies. It'll get them a deduction. You don't have to rent it out for the entire year. You just have to get it into service. And I've talked to people before that have picked up properties and they go through and they rehab them and they want to do this study. And I tell them you can't do it because if you're still rehabbing the property, it's not yet in service because you have not yet rented it out. So my recommendation is typically if you bought a property that you intend to rehab, first put it into service, rent it out a few times as is, then take it out of service, and then do the rehab work on that property. So at least you qualified for the in-service requirement that comes with any type of strategy with rental real estate. All right, so I see I got some questions here, and let me just scroll down to them. Okay, so Taylor, how long do you have to rent it as a short-term rental before I can turn it into a long-term rental? Just for the tax year, that's it. Taylor, that's all you gotta do. Just rent it out for the tax year and you're gonna be good to go. Sean, I live in California and self-manage my rental properties located in California, Arizona, and Tennessee. Can I use a statutory trust entity to self-manage my rentals from my home in California, achieve anonymity and asset protection? Okay, Sean, so you're asking something that's off topic, but yeah, that's why you're here. I tell you to come back here whenever I'm doing these live events to get your questions answered. So here's Sean's question. What it comes down to is he's a California resident and you all know, if you live in California, if you set up a limited liability company, I mean, he has properties, he stated, in California, Arizona, and Tennessee. How would I go about structuring those to minimize the taxes or the franchise taxes? So you got a lot going on there. What I would do in California is I would create statutory trust, Wyoming statutory trust for my California property, like this. I would have a Wyoming LLC trustee up here. So this would be how I would structure California. Then when I went into Arizona, what I would do in Arizona is I'd create an LLC for Arizona properties like this, and I would have that LLC owned by a Wyoming statutory trust down here. Because the thing is, I don't want you to own an interest in a LLC directly, because if you're owning the LLC, then you're going to be subject to that $800. So my Arizona stuff, I'm going to structure this way. Statutory trusts don't work well in Arizona, so I don't typically use them there. And so again, this would be the trustee. And then in Tennessee, it's a different animal altogether. Okay, so in Tennessee, what I would do there, depending on how many properties you have, of course, is that if you want anonymity, then in Tennessee, you're probably going to use land trusts like this, have the property in a land trust, and then I would set up a different LLC here, a series. I'd do a Delaware series with individual cells to own my land trust. Now, why did I change it up? So you see, we have 3 different structures here based upon 3 different states where you're investing. Because when I'm in Tennessee, they have a franchise tax in Tennessee for business entities. And so if I set up an LLC and I want it owned by a statutory trust because I want anonymity for my limited liability company, then I'm going to be subject to franchise tax, and I can't qualify under what we refer to as the fonts exemption. So to get around that, I'll use land trusts and have it held by an out-of-state Delaware series, put it into individual cells. You could do it that way, or you could just set up a Tennessee series LLC and just create individual cells also for the properties. But if you do that, you have to file for a fonts exemption for each of your cells. So there's a little more work involved, but that would work as well. So you have 2 different ways you could go if you lived in Tennessee. Complicated question, not maybe the easiest answer for many people to follow here, but what are we designing this around? We're designing it around the Republic of California wanting to charge you $800 for every structure you create, every LLC of which you're a member in, regardless of where that property or that LLC is actually doing business. You got a follow-up question here. Does Anderson recommend my living trust be something other than my personal name? Now, for your living trust, I would use your personal name because you're going to be opening up bank accounts in the name of it. It just tends to be simpler to do it that way. You're free to change it any way you want. You can. I mean, my living trust, I don't use my personal name on that. That was a choice that I came up with, and you can get it done. But you know what happens is when I gave them to Chase, when I opened up the account there, they looked at the name of my trust and they said, "Well, this is odd." I said, "Yeah, it was an animal that we really liked, and so I decided to restate the trust with that name." So you can do it, but it just, sometimes people will look at it. All right. Question from John. How much does it cost to set up asset protection for one rental property and our primary house? Well, it's going to depend on your state, John, on how much that's going to be as far as the filing fees are concerned and what type of structure we're going to use. What I would recommend you do, John, is attend my tax and asset protection workshop. We'll put the link up here so you can all get to it. But at the tax and asset protection workshop, so about every other week, I will teach an event with my partner Toby Mathis. It's on a Saturday. It runs from 9 to 4 o'clock Pacific Standard Time. And out at that event, we'll be teaching you these types of strategies, showing you how you can use cost segregation, depreciation, rep status for your real estate. I'll be talking about LLCs for short-term rentals, long-term rentals, corporations, land trusts, how all that fits together to protect yourself. And then typically, well, we have a great offer that's available. And if you're thinking about engaging in our services, I would highly recommend you attend our event, because my partner and I, we throw in tons of bonuses for the people that take Saturday to be with us. And that's how I would say you start off, if you want to engage with Anderson, you go to that event. All right. Taylor, does the 500K maximum only apply to offsetting your W-2 income? If I make 600K trading stocks, can I only offset 500K of that from the cost segregation study? No, so you could take if you make 600,000 trading stocks, you can take the $500,000 loss and apply it to your stock gain, Taylor. So yeah, you can use it against any forms of income, provided you've met that test that I was talking about. All right, John Pierre, I'm struggling to see the benefit of short-term rental. The cost segregation study can be done whether it's a long-term rental or short-term rental. Correct. Cost segregation can be done whether it's long-term or short-term. But Jean-Pierre, the benefit is that when you perform a cost segregation study, okay, let's assume that you have a house here, and this cost segregation study provides you $75,000 in losses. So unless you have the other types of income, passive income, to offset these losses, they're not going to do you any good, right? They're just going to sit there. They're going to be suspended. Yes, you can carry them forward, but you can't take it. Let's say you got W-2 income over here of $325,000 a year. You can't use these losses to offset this income unless you are a real estate professional that we talked about with material participation, or you use the short-term rental loophole, which is spend 100 hours more than anyone else on your short-term rental properties with an average rental period of 7 days or less. Now all of a sudden you've freed up, you've changed the character of these losses so that you can offset your other income. That's the benefit. That's what people are going for when they're looking at short-term rentals. Now I know there's the income side as well. I mean, I've dealt with people that that have short-term rentals that they kill it. I mean, they're making $75,000, $100,000 a year on their short-term rentals, and if you give them $75,000 in cost seg, it's going to offset that income. So they don't really care so much about trying to meet meet a test, because the income matches up to the types of losses that they're pulling down. So it really depends on your tax situation, whether or not you would want to take advantage of this. But it's a great question. I'm glad you asked it. Okay, Sean, 61-year-old and retired. I own a single family, debt-free with my self-directed IRA. I would like to take a distribution. Can I request my self-directed IRA distribute the property to me? Well, I mean, you could just close it down and distribute the property to yourself. And if you did that and distributed the assets, you're going to be paying tax on the entire amount of the distribution. Maybe that works for you. That is a problem with owning real estate in IRAs, is that when it comes time to taking your RMDs, you have to either liquidate the assets if you don't have enough cash in there, or shut the entire thing down. So I would talk to your custodian and say, hey, if I just want to close this down, just distribute it out to me, what that is going to look like from a tax standpoint to you. Okay. Jay, if you have a conventional loan, how can I move it into an LLC? The lender says no. All right, first off, Jay, with the lender, don't ask the lender for permission to move your property into a limited liability company. I just actually responded to one of these questions today on my channel. And the thing is that with most loans, if it's residential real estate, and you're using a qualified mortgage, it's underwritten by Freddie Fannie. And Freddie Fannie guidelines permit you, if they're using Freddie Fannie underwriting guidelines, to move real estate into a limited liability company, and it won't accelerate. Now, they won't change the loan to the entity. That will never happen. But you can retitle it into that entity. if it's a qualified mortgage. If it's not non-qualified mortgage, then most of those lenders don't care anyways. They'll allow you to do it. But if you're concerned, then I would suggest you do this. You set up a land trust. So here's your property. You deed your property into a land trust, and then you have the land trust held by a limited liability company for that asset protection component that the land trust doesn't provide. And the reason you're doing this is so that it appears to be a grantor trust for purposes that the lender looks at the property transfer. If they were to pull the deed on it to see what's going on, then it's held by a trust. So that's a backup to it, but you're always going to get that answer. If you, in my experience, if you call up a lender and say, hey, I want to move my mortgage, the answer is going to be no. If they said yes, it's going to come with a cost. So I don't even ask the question. And you know, in 23 years of doing this, I haven't seen it, never seen a lender accelerate, because unless, of course, I take that back. I've seen it a few times, and they all came down to someone not insuring their properties was the issue, or they weren't paying their mortgage. And so that was the cause of the acceleration. All right. What is the best tax strategy for rental arbitrage on short-term rentals? So what's being asked here, if you're not familiar with rental arbitrage, so what happens there, it's basically somebody else owns the property. It's like a sandwich lease option, but without the option component. So this is owned over here by Frank. He owns the property. And then MN, who asked the question, comes here in the middle, enters into a lease agreement with Frank. So I'm going to lease this property for, let's say, $1,500 a month. Then I'm going to short-term rental it out and hopefully bring in $4,000 a month from my short-term rental. So that's the arbitrage there. You're going to take the difference between these two of $2,500. So what's the best tax strategy? I'll give you a tax strategy. Do it through an IRA. That's your tax strategy, a self-directed IRA or a solo 401k plan. That's how I would run it, because that way the money is not taxable to you. It's either tax-free or tax-deferred. I mean, you want to blow up a Roth, self-directed Roth IRA or a Roth 401k, rental arbitrage or lease options is an easy way to do that, because you're not coming out of pocket. I mean, just think about it. If you had a Roth IRA right here, self-directed Roth, right? How much would you need to set up this deal? If you found a willing property owner to lease you the property, you're going to need what? Maybe first and last and a deposit. So maybe you need $6,000. Oh, wow. How much can I contribute to my Roth this year? I'll put in $6,000 into my Roth. Now I've got my seed money in that deal. Now here's the thing. You can't give a personal guarantee on this. All right. If you give a personal guarantee, that's a prohibited transaction. But at the same time, if you did do a prohibited transaction, well, it's only $6K, right? So you can figure that one out on your own, how you want to run that. But the thing is that by doing this now, you get that property locked up, and then you start leasing it out of your self-directed IRA. That or in my example, 2,500 keeps flowing in there. Let's say that's, multiply that by 10 months, you just made $25,000 inside of your IRA. If you did it for the entire year, now you made $30K inside of your IRA, all tax-free. And if it's a Roth, it's going to be tax-free when it comes out to you. So your answer is use a Roth. Now, if you don't want to use a Roth because you want to collect the income personally, then I would just use a straight-up limited liability company, unless you're looking for some tax benefits that a C corporation could provide you. You're going to pay a little higher personal tax rates to pick up those benefits. So you'd have to analyze it, is what I'm saying. So there's different ways to go there. All right, great question. I'm purchasing a short-term rental with a couple of partners. Cool, great. And the question, I think, is how to structure that short-term rental if you're doing this with a couple of partners. Well, one way you could structure it is through an LLC, like this. And each of the partners could own an interest in that limited liability company. Generally speaking, I'm going to tell people don't own it directly. You should have a holding LLC holding on to your interest, just in case anything goes wrong with any of the partners on the personal level. You don't want to, you know, tie up your joint venture LLC. Now, let's say this partner right here, right, he's going through a divorce, and then next thing you know, that attorney's all up in your business. And so that can be an issue. So by using LLCs as the partners, you help insulate that. So the problem will stay down here and not up here at the property level. So that's one way to structure it. The second way you could structure this deal is you could own it as a TIC, as tenants in common. So you could come up here and you can have each of you, again, use your LLC, 3 LLCs on title to the property in that manner. Now, why would I go that route? Well, I would be looking at what is my exit strategy. If I'm thinking that we're going to do this for a year or two and then we might sell the property, I want to make sure that I can preserve the ability to engage in a 1031 exchange, and my business partners, they can do whatever they want with the money. Maybe someone wants to take the proceeds from the sale of that property, go out and buy a boat, good for them. But if we held it in this manner right here, that would prevent us either all in or all out on a 1031. But when you do a tenant in common, each partner is free to do whatever they want with the money. So again, different ways to structure it based upon, you know, what the motivations are of the parties. All right, so what is deductible on short-term rental property? Well, I mean, that just goes down to a whole laundry list of things you can write off. You can write off all your advertising, the fees you pay to have it managed, the cleaning fees. You know, all the expenses associated with running that property are going to be deductible. If you have to buy something or you need any work done, you know, you fall under that de minimis $2,500 rule, where if it's $2,500 or less on the invoice, that is fully deductible. So when it comes to your property, there's not a lot that you can't write off typically, unless it's an improvement to the overall asset and you're improving the structure. And that's why we use cost segregation, which, by the way, is another thing I should throw out there, is if you're going to use that, if you're going to rehab your property, say it's a short-term rental or even a long-term rental property that you want to go through and you're going to do some extensive rehab, you might want to make sure you look at this. It's called a PAD, partial asset. Gosh, the D just threw me. It's not distribution, but I'm having a blonde moment there. When you do a PAD on your property, disposition, there we go. What happens is that you add up the components that you're removing and you can deduct those. A lot of people miss this when they're doing rehab work. They don't figure out what is the value of the components that they're taking off of their property and the cost of removal, and then deduct them on their tax return. And if you do this and you deduct on your tax return, don't forget that when you put on the new stuff, you can also get a deduction for that by doing a cost seg on it and selecting bonus depreciation. I mean, this is the key right here. You want to get massive tax deductions on properties that you're remodeling. This is what you want to be doing. Otherwise, your CPAs are steering you down the wrong hole and you're missing out on a lot of opportunities. I'm purchasing a short-term rental with a couple of partners. One of us is going to get a conventional mortgage. Then after closing, we will deed the property into a partnership LLC. How will we still deduct the interest? Oh, well, that's going to be, so in that case, the interest will be deducted against the property itself. So what will happen is the LLC is going to file a tax return, and then it's going to take that interest deduction at the entity level, come out on the 1065, and then it's going to wash out to you on the K1, because when you set it up in an LLC, that's going to be treated as a partnership. So the entity is the one that will take the deduction, because the entity is the one that's actually going to be paying it. Clint, I'm on chapter 7 of your first book. Okay, not my latest book. You're working your way up there, Victor. And I wanted to know what direction to take in terms of structures to set up for taxes. I buy and sell land, no improvements. I buy at 25% and sell at 50%. Well, you know, in a case like that, it really depends on what, you know, your tax situation is. You could either use an LLC or an LLC disregarded or an LLC taxed as a corporation. The problem that you could potentially run into is if you're doing it is you get tagged as a dealer. And of course you wouldn't want that. And if that's a concern, then I would have my LLC treated as either an S or a C corporation for that type of activity. And yeah, I just saw the post here, tax and asset protection. There's a link right here. Just go to aba.link/Clint Coons live, and you can sign up for that event that I have coming up, not this Saturday, but the following Saturday, the tax and asset protection event. All right, Teresa, do you need to have bank accounts in your living trust name? Do I need to transfer the bank accounts over to your living trust? Yes, you do. But when you transfer your accounts over to your living trust, your checks will still have your name on it. Your checks will not change. Only the statements and the account will change to the trust name itself, but your checks will continue to read the same. So if you're not going to be writing a trust check every time you're sending out your bills, or if you're writing a check at the grocery store. So all that stays the same. All right. Where are we? Jay. If I want to take bonus depreciation, can I carry forward the losses if I don't want to use the entire amount in 2022? And yes, you can. And it's indefinite, Jay. You can carry forward those losses indefinitely. And so here's something that I've been telling people. If you have properties now and you think you may be selling a property in the future, start taking the bonus depreciation, start building up those losses to help offset the gains that may come from a property, another property you sell in the future. So there's no problem with stacking up the losses that you can use to offset future gains. Because after this year, any properties you acquire, the bonus depreciation is going to start decreasing over the next 5 years by 20%. So next year, it's only 80%, then 60, then 40, then 20, and then it's gone. Now, there's two ways to interpret the Tax and Jobs Cut Act. One states that if you do the bonus depreciation next year, then it's only 80%. Another interpretation is that if the property was acquired between, say, 2018 and 2022, even if you do the cost seg next year, the bonus depreciation is 100% because it relates back to the date of acquisition, not when the study is actually performed. So taking the losses, I think, is a good thing to do, and then stack them. I live in Hawaii. Would your platinum member service be applicable to me? Well, you know, so our platinum member service, if the benefit of the platinum service is this: you have questions, you can call in, you can speak to an attorney, all right? And so that's going to help. If you have a document where you want reviewed, you can have an attorney look at that. We'll review 2 documents a month. So there's a huge benefit there. And the thing about it is, you're dealing with people who work with real estate investors all the time, so you're going to get that angle to it. And that's unusual. And I tell people, you know, when you go and you talk to an attorney, how many attorneys are doing what it is that you're doing? You know, you're using terms that are terms of art that they're not familiar with, and then that's going to cause consternation because you have to then explain to them how the strategy works. Like, you know, rental arbitrage, short-term rental arbitrage. How many attorneys understand what that term is? And if you bring it up, they might steer you down the wrong road because they don't get it. So there's a lot of benefit in there. Now, if you're asking, can we draft state-specific documents for you in Hawaii? No, we cannot. We've got hundreds, probably at least 300 to 400 clients, if not more, that live in Hawaii that we work with. And they get tremendous value out of the platinum. And then you get the tax side as well. So as a platinum member, if you have tax-related questions, you can send those in. And those questions will be answered by a CPA, and you'll get a response on your taxes. So there's a lot that's built into it. You've got access to videos, state-specific forms you can download and use in your investing. But the crux of it, which keeps so many people involved as a platinum members with Anderson, is just the fact that they can call in and ask the questions. They can speak to knowledgeable strategists or attorneys about their individual situation. And you know, at $35 a month to maintain that level of service, I think you can't go wrong with that. Just one phone call is going to pay you back dividends for the entire year. All right. And that was not a plant, by the way, for these who are wondering, oh, he's a shill that Clint put in there. It's not. Daryl. Chehalis, Washington. Great, I own rental properties. This is so interesting. Daryl, good to see you. All right. What do we got here? Is it okay to hold short-term rentals and long-term rentals under the same master series LLC? Yes, you can hold them under the same LLC. That's not a problem. They just get broken out separate on the tax return. You know, depending on the size of your portfolio, again, what you're doing, if you're qualifying as a real estate professional, not an issue. But if you don't, you're going just the short-term rental route, it might be easier for you or for your tax preparer to separate the two out. Maybe create a separate master LLC just for the short-term rental business and keep a different master LLC set up for the long-term rental business. So great question there. Follow-up previous question. How does a California resident investor protect his personal assets from personal liabilities? Can a WST be used as the entity instead of an LLC to avoid franchise taxes? You can use a WST, but if they're personal assets, you're not going to be protected. And in fact, the biggest mistake that I find that a lot of people make that are concerned about asset protection is they want to take all their personal assets and they want to put it, let's say in your case, a WST. So they put, you know, their jewelry into here, they put their vehicles, their boats into the WST, and they think they have protection, but they use these on a daily basis for personal benefit. So there's no business purpose here. And if there's no business purpose here, then that entity fails. And what happens is if that fails because it lacks a business purpose, that is the only reason why you set it up as for asset protection, it could be a domino effect for all your other entities as well. That's why, you know, I'm telling you, you come to the event, I break this down. I have a matrix I go through at the very beginning of the event. Within the first hour, I break down personal assets versus no risk versus business assets. And I show you these are the types of entities we use for these specific types of assets in these situations. And if you don't see the entity listed there, you should not be contemplating using that type of entity because it's not going to help. It's going to do more harm than good. After setting up a Wyoming LLC, how do you assign ownership to your revocable trust? That's just a document. That's all you do. It's just an assignment of membership interests. It's really simple. Once you've set up your LLC, it's just an assignment of interest. Teresa, if you're a client of Anderson, just call us up and we'll draft that for you. In fact, when we do a funding call with you on your trust, after your living trust has been established by us, we will then start looking at that and making sure that those types of things haven't been missed and those interests have been transferred over. Dustin, you self-manage short-term rental remotely, but you hire a cleaner. Do you need to have more hours in your cleaning service? You bet you do. You got to have more hours in your cleaning service, and you need to get statements from them stating how many hours they work on your property, because if you're audited. So when we're talking about that bonus depreciation, you got to have good books and back that up with your hours, because you're taking a huge chunk potentially off of your tax liability. And if you're picked for audit, which the likelihood is really small. I'm going to go sidebar here and go off on a little tangent. I've been getting questions from people. They're talking about the Inflation Reduction Act, and all that money, billions of dollars that we've allocated to the IRS, and what does that mean for you? Well, I can tell you what it means for you. Not a heck of a lot. Why is that? Look at what they say in the economy. You can't find employees. So where is the IRS going to find employees to work for them? Number one. Number two, if they do find the employees, who are they willing to pay what it takes to get a tax professional that you're going to need to audit individuals' business returns? Because there's very specific auditors that are allowed to audit business returns. Most people auditors handle 1040s. We have some ex-IRS attorneys. I mean, if you want to be a platinum member, you can actually talk to ex-IRS attorneys that will tell you if you have 1,000 auditors in a room, 990 are auditing 1040s. They can't touch anything else. 10 of them are handling 1065s, 1120s, so partnership and corporation returns. So they have a different skill set. Those people are extremely hard to find right now. I know that. We have a huge tax department inside of Anderson. You know, we have the legal and the tax side. And our tax department, we have to turn clients away because we just can't get the personnel right now. So if we're struggling, and I know I pay more than the IRS, how are they going to find the people? So don't let that deter you, the thought that, oh, I may get audited because they're hiring all these people. I don't think, see, it's coming. And if it does happen, they get more people to work for them, use more business entities to hold your income. 1065s is what I'd be using on the rental real estate side, for sure. All right. Any tax issues deeding a property from a trust where I've been the only trustee into my personal name? Now, I'm going to tell you generally no, okay? But I got to, cover my own assets on this one. It really depends on where you live in the county, and I don't, of course, know all those. We have a deed department that looks into that to make sure that it is an exempt transfer. The last thing I don't want you to get hit with is a transfer tax on that or a reassessment. But generally speaking, it's not going to result in either. From a federal tax standpoint, if it's a grantor trust, it's not an issue. Are short-term rentals subject to self-employment tax? Robert, what a question to ask. Okay, here's the answer you never want to hear from an attorney, right? It depends. So it can be, okay? So where does it come up? If your rental period, okay, so if you qualify with 7 days or less, okay, and you've got the 100 or 500 hours involved in that property, and you provide substantial services, then you can get hit with S&E on that deal. All right, so this is the determining factor for the 7 days. So yes, in limited situations, if your activity level rises to the point where it looks like you're an employee or you're operating a hotel-like business and you're providing all these additional services and it's a 7 days or less, then it could potentially hit your Schedule C. For the most part, for most of us, it's just going to stay on Schedule E. It won't go there. If I change into a long-term rental in year 2, can we still use unused depreciation from the cost seg? Absolutely. It does not go away. You still carry that forwards. If I get a promissory note on a property that has a low mortgage interest rate, how can I get the property within the LLC to be doing short-term rentals, then convert to long-term rentals? All right, so maybe your concern is that if you transfer it in, that type of loan, the lender might accelerate. Then what I would suggest you do is what I said earlier, use a land trust. So take your property, put it first into the land trust, and then have the land trust owned by the limited liability company, if that's a concern. Otherwise, it's just a matter of deeding the property in. You're considering purchasing a multifamily with a partner, how to structure it. Well, that's going to be decided based upon your lender. Generally speaking, if you're buying a multifamily with a partner, you're going to take that deal down inside of a limited liability company. They're going to want you to set up an LLC for that. Now, I don't know that, of course, I'm not going to get into the details here with you, but who's going to go on the loan? Who's going to give that personal guarantee? Sometimes when you take these down, if you've got another partner here involved and that partner has challenging credit, what I'll do is I'll keep that partner off and give this partner what's called a springing interest in my limited liability company, so that for purposes of closing with the underwriter, and they know all of this, you're the only one that's listed on the LLC operating agreement. You close on the property. After closing, then this guy's brought in as the member. It's also not a bad idea to set up your LLCs with a springing interest, because when you're applying for these loans, you don't want both of you to have to go through underwriting. So to avoid that, just use one member and have them go through underwriting. And then if you're going to do another deal, have the other member go through underwriting on that, because some of that stuff could hit your credit report, and you don't want to keep getting dings on your report, because it's going to drive that down, because who knows what other deals you have going on. So you can look at structuring in that manner. Now maybe you need both of you on the deal. That's a different scenario than you would just structure it through an LLC like this. And in asking the lender, if you many times, or in some situations, maybe this LLC is a Delaware limited liability company that's foreign filed in the state. It depends on deal size as well, on how that entity is going to be structured. So, arbitrage question. I have a Delaware corp with an LLC and trust. Do I want the cash flow initially? I do want the cash flow initially. So will I need a separate LLC for the arbitrage? Do I need separate LLCs per state? Well, yeah, if you're doing separate agreements per state, you're actually conducting business in that state. So either you're going to set up a separate LLC in that state, or what you're going to do is foreign file the LLC that you're currently using in multiple states, register to do business there. So I wouldn't do a lot of arbitrage in one LLC, and here's why. So if you set up an LLC here for your arbitrage, and you've got, let's say, 5 deals running through this one LLC like this, and you find out that this property right here, it's a dog, no one wants it, and so you want to walk away from this deal. Well, if you walk away from this one, they're going to come after the LLC, get a judgment against the limited liability company, and these wins that you have over here, all that income coming in, they're going to go after and garnish it. So you may want to limit how many deals you run through one limited liability company, just because of that potential eventuality that could crop up. But generally speaking, you do need to register it in every state in which you're doing the deal. I owe back taxes, and the firm I'm working with is setting up a C Corp. They have my salary to be low. That way the offer and compromise will be done. Any issues you see with this? No, if all they're asking you is for the income, that's all you have to disclose. If you have to disclose any business interests you own, well, then that could come up. I'm not a CPA, and I don't deal with that side of it in our practice. But if they're telling you this is the way to go, then yeah, hopefully it'll work out in your favor. All right, separate LLC, set up to have purchased properties. I'm not sure if that's probably a follow-up to something else, but I think I already answered it. If I have a living trust and I'm going to purchase an out-of-state short-term rental, do I set up an LLC in that state and name my trust as the member of the LLC? Eva, for anyone listening, do not list your living trust as a member of your limited liability company when you set it up. Always set up your LLC as one of 2 ways. If you're not going to use anonymity and set it up with a Wyoming holding like I talk about, and you want to use yourself as that initial member, okay, you're going to be involved in it, and then here's my trust over here. You're going to be the initial member on your operating agreement, and then you assign your interest to your living trust. Why? Because when you go to open up a bank account for this LLC, they're going to ask you for a copy of the LLC operating agreement. And if they see your living trust, they're going to tell you to come back in and bring your living trust with you, so they can review your living trust to see what's going on there, to determine whether or not you have control to open up the account. And it just slows everything down. So I don't want to see a living trust listed as a member on an operating agreement. I want to see an individual, and then take that interest and then assign it over to the living trust. And so if anybody ever asks you for a copy of your LLC operating agreement, and you're the one that's involved in it, you send them over to the LLC and they see your name there and not the trust. So that's how I like to run it. My CPA does not understand short-term rentals and cost seg. Do you have CPAs you can refer me to do that? Yes. In fact, my partner Toby just did an event today with cost seg, and we can give you a link to that to help you out there if you're looking to get that done. It's a CPA that we work with that does that. So guys, if anyone's on, it's on here on my staff side. If you have that link to Toby, you can reach out to Patty, by the way. She can provide you the link for sure, and we can get that posted right up here. Sal the Pal. My CPA that I worked with on the personal taxes mentioned that he can create an LLC for my future business venture based out of Arizona. Is that CPAs? Yeah, CPAs can set up entities. There's no problem with that. Yeah, definitely. You could do it that way, Sal. All right. Keys and coffee. More info on deeding from the trust into my name. Property is in Oregon. I'm in Harris County, Texas. Yeah, I don't know that off the top of my head, but I would assume if it's a grantor trust, you set up the trust, you're the trustee, you're the beneficiary, it should not be a problem to take that out. Shouldn't be an issue. Single family rental rented for 15 years, never been cost seg. What is the best plan now? Well, I don't know, Brenda, if I would do a cost seg on this property. I mean, you can pick up some accelerated deductions. You might be able to double your depreciation for the next 5 or 6 years. So you have to then analyze it. So what is the value? What is your basis in the property? What do you acquire it for? Is the first thing. What is it currently worth right now? And then make a determination as how much additional depreciation it's going to give you. It's not going to give you that pop of the bonus since you've owned it for 15 years. I mean, the bonus depreciation has been, you know, the Alaskan goldfields for a lot of people as far as tax deductions for the last couple of years. But that's not to say we're still doing cost segs for our clients. It just wasn't as juicy as it is right now on the cost seg side before 2018. Can a WST be used in place of an LLC for a California-based owner, self-manager who manages his out-of-state property to avoid franchise taxes? Yeah, you can use a WST in place of an LLC. There's no problem with that. I have 3 rentals, each in different states, all held on my name. How do I begin to structure my holdings to protect myself and my wife? Well, you know what I'm going to say. You got to be on my event. That's what you need to do. I'm new at this and I need a plan to get started. So here's the issue. I can't give you I can give you an off-the-cuff answer. What I could say is this. Well, if you got rentals in different states, set up 3 different LLCs like that. You can have them all held by a holding company. But the problem is, as you notice at the about 40 minutes ago, somebody asked a question, and I forget his name, where he said, hey, I own property in California, Arizona, in Tennessee, and I live in California. And I said, all right, well, in that case, we're using a statutory trust, an LLC, and then either a series LLC with land trust or a straight up series LLC back to your holding company, because wherever those rentals are located, you desire the asset protection that comes from having the structure set up. But at the same time, you would be really upset with a professional who set up the LLC for you that then triggered a reassessment on your property taxes or triggers a franchise tax that you wouldn't have to pay otherwise. There was an individual I started working with a couple of years back that when he first came to me, he was spending $45,000 a year in franchise taxes that he wasn't obligated to pay, but the CPA he'd worked with screwed up the structure and didn't understand how it worked in that particular jurisdiction. So it does matter. Hey, I live in California, considering acquiring a short-term rental in Texas with property manager. Would I have to log more hours of material participation than the Texas manager? And I'm an out-of-state owner. Yes, you do. You gotta log more hours than your manager. If you're going for that 100-hour requirement, you add up all the hours, the manager, the house cleaners, guys coming out, and fixing things that break on the property. All that time gets added up, and then you've got to be putting in more time than that if you go with the 100-hour route. But if you go with the 500-hour route, that's not a concern. All right, so I saw we just put up the link there for cost segregation benefit analysis. that just went up there, guys. So if you're thinking about doing a cost seg, go ahead and you can click on that link. It'll take you to a form where it'll be sent over to Eric, who does our cost segs. He's a CPA, and he'll reach back out to you. Many times, the best thing about it is that they're not going to charge you to do something that's not worth it, and they'll tell you based upon your property. They'll just give you a quick off-the-cuff answer. They'll say, hey, if your property is this amount, and you describe it to them, they'll tell you whether or not you should move forwards with it or not. Jordan, good to see you join the party here. Clint and his team manage all my LLCs, started doing business 4 or 5 years ago and haven't looked back. Hey, buddy, I appreciate the plug. Again, not solicited. Love to have you on. We haven't talked in a while. Jared, is an LLC owned by a married couple's revocable living trust categorized as a single member disregarded entity or a partnership for 1065 purposes? Jared, your LLC, whether or not it's a partnership or a disregarded entity, that determination was made when you applied for your EIN number. So I don't know. Whoever set up the LLC would have made that election. Now, if it's owned by a living trust, a joint living trust, and you live in a community property state, it could be disregarded. It could also be a partnership. If you live in a non-community property state, then technically it's supposed to be a partnership. However, if you issued the interest to the trust in such a way that it was held by one spouse as the trustee, so it said Jared is trustee of the Fennelson Living Trust, and your wife's name was left off, then it can be disregarded. You see how confusing this stuff is? Who writes all these laws? Must be attorneys. Gosh, scammers. But anyways, guys, hey, thanks for coming on. I know we went 12 minutes over today, but a lot of interest in this topic, a lot of great questions, and I appreciate you watching my YouTube. Be sure to keep checking out the videos. If you haven't yet subscribe, recommend to your friends, and also check out my new book. It just hit Amazon a couple of weeks ago, so you can read that as well. It's a follow-up to my first book, Real Estate Asset Protection, or Asset Protection for Real Estate Investors. This is the next level, and great resource. But other than that, look forward to seeing you next time we do this in a couple of weeks. Take care, everyone.